I think in the current environment, most companies, REITs included, are trying to head off unwanted risks and attention. So they're scrubbing their documents to eliminate words or acronyms that might draw eyeballs and unwanted attention. And I think that makes sense. I think it's a thoughtful approach. I think it's necessary in the current environment.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. This week, we're looking at the future of sustainability reporting and the practical steps that REITs can take to navigate the current landscape. With me to unravel all that is Rob Main, managing partner at the shareholder advisory firm Jasper Street Partners. Rob, thanks for joining the podcast today.
Sarah, thanks for inviting me. I'm looking forward to the conversation.
Great. So, Rob, what would you say the mood of the 2025 proxy season is likely to be, broadly speaking? And do you think the REIT industry will be facing a similar sentiment?
Yeah, I think the word of the day is anxious. I think going into the season, companies across industries, including REITs, are anxious. Stock market volatility is up. We have an increasingly shaky economic picture. Tariffs and other policy changes have really cast a cloud over U.S. companies. Having said that, though, I think if we think about annual meetings, the heart of what proxy season is all about, I think that for many companies, as long as they've been engaging with their investors, they have good disclosure, and they aren't viewed as outliers by institutional investors, they're probably going to have a good proxy season. And for the handful of clients that have already had their annual meetings, they've had great success.
And how are large institutional investors approaching this proxy season?
Yeah, so if companies are anxious, I think investors are cautious. They don't want to draw too much attention to their activities. So whether it's that public advocacy or their voting. Also today, they're less willing to push companies on environmental and social topics. And given some recent SEC guidance around big shareholders, so think your BlackRocks and Vanguards of the world, they're now going to be more limited in what they say to companies during shareholder engagements. So I think institutional investors are going to be a little more tight-lipped. However, I think one sort of core belief remains in place, which is they believe companies should have strong governance practices. So the right people in the boardroom, shareholder rights that empower investors, and reasonable executive compensation practices.
And is ESG, or sustainability as it's more commonly referred to these days, a hot button item this proxy season? And do you expect the various interested parties to approach it in different ways?
So I would say it's still a hot button issue, but it's a little different than it has been in prior years. And I think at the core, if you think about your institutional investor base for a company, they still want to understand how companies are addressing financially relevant issues that may not show up on the balance sheet today. So issues that might impact the business down the road. In terms of proxy season, we are continuing to see a large number of shareholder proposals, both pro-ESG on issues like climate, DEI, workers' rights. But we're also seeing a tremendous number of anti-ESG proposals as well. So in many ways, ESG as a topic or sustainability, however you want to define it, it's still a hot button issue. But I think one of the takeaways will end up being from the season is that we're probably going to see very few proposals get majority support from investors.
And what about proxy advisors? What sorts of positions are they advocating this year?
Proxy advisors have been very quiet. The way that I would describe the sort of evolution of their policies this year is they've held the line on the proxy practices and guidelines they had historically. They have not made any progress. And again, I think that's an effort to stay under the radar. No one wants to sort of pop their head up and get attention in this environment, and the proxy advisors are no different. Having said all that, the one notable policy change came from ISS, where they are no longer going to criticize companies for lack of board diversity. And again, that's a 180 change from where we've seen their policies go over the last several years.
Rob, let's talk a bit about how companies can position themselves to deal with a particularly polarizing sustainability reporting environment. First of all, how are you recommending they approach their shareholders to avoid possible friction?
This is a challenging issue, and probably more challenging this year than it has been in prior years. However, I do think sort of one baseline or best practice for mid-size and large companies is they should have a year-round shareholder engagement program. And what that means in practice is think of it in the opposite 6 months, opposite their annual meeting. They should be engaging with their top investors, top 20, top 25 investors, to better understand their investor priorities, to build trust and rapport, and to potentially uncover any points of friction between what the company is doing and some of the policies of those institutional investors. A quick story, we had a large cap client recently really dedicated its fall engagement activities, so fall of 24, to really try to educate institutional investors about how demand growth for their products was going to potentially impact their ability to achieve some of their goals in terms of reducing their carbon footprint. And overall, that led to very productive, rational conversations with investors. What that has done is position that company for clear sailing in this proxy season. So they have less shareholder proposals than they did the year before, and it's unlikely any of those proposals will get strong support from their investors. So I think just having that dialogue goes a really long way towards building that trust and rapport.
And what about assessing strategy? What should REITs be paying attention to in order to ensure that they're well positioned for possible shareholder inquiries?
Yeah, so the first thing that comes to mind is it's incredibly important that the sustainability strategy is aligned with company strategy. So making sure the two are integrated. If a company's talking about priorities for its sustainability program, there should be obvious, clear linkage to how that's going to help the company to better deliver for shareholders and other stakeholders long term. So again, that alignment has to be there first. The second thing I'd focus on is the disclosure. Is it clear? Is it transparent? Is it effective? And again, that applies to the 10K, that applies to the proxy statement, that applies to the sustainability statement, really the whole portfolio of how companies are communicating their sustainability strategy. And then the last piece that I would highlight, and again, this is very relevant for how institutional investors might evaluate a company that's in a group of other companies. So think about REITs, right? How do they stack up versus their peers? So how does the company look when it comes to disclosure? Is it better or worse than their peer set? Are they describing and creating goals and commitments similar to their peers? And in a lot of cases, institutional investors, they're looking for outliers. So being aware at a company level of how it stacks up versus its peers is incredibly important. We just helped an industrial client through this exercise. They were thinking about pulling back on some of their climate-related disclosure. And we took a look at a peer set of about 20 companies to help them to better appreciate sort of how they stacked up. And after pulling that information together, sharing it with the executive team, I think they realized they were sort of in the middle of the curve, and that's where they wanted to be. They wanted to be in the middle of the pack. They didn't want to be an outlier on either extreme. And based on that conversation, based on our research, it helped them to sort of reaffirm their current positioning relative to their peers.
So, from what you're saying, it sounds like REITs really should still be disclosing their sustainability achievements.
I think they want to understand what are the key topics. They want to understand both qualitative and quantitative information related to those topics. I do think touting achievements, though, again, in this moment is a little tricky. I think if companies are seen as being too vocal on certain topics, that can make them a target. So I really think they should be focusing on understanding their investor priorities, clear disclosure, making progress on those goals and commitments. But I've yet to talk to an investor recently that really is focused on ratings or rankings, or is really focused on some of these scores that come out for various companies. It's more about understanding the why sustainability issues are important to the business, how they're making progress, what that disclosure looks like. But those top line ratings and rankings are probably less relevant today than they were a few years ago.
Rob, do you have any additional advice for how REITs should ensure their messaging is fine tuned to the particular demands of the moment?
Yeah, I think in the current environment, most companies, REITs included, are trying to head off unwanted risks and attention. So they're scrubbing their documents to eliminate words or acronyms that might draw eyeballs and unwanted attention. And I think that makes sense. I think it's a thoughtful approach. I think it's necessary in the current environment. What I worry about, though, is companies might overcorrect or overcompensate and start slashing components of their sustainability program because they're not popular today. And I think what that does, if they do that, is it might destroy trust with their institutional investors. As one large fundamental investor said to us recently, if a company can just slash or eliminate a program or effort that a year ago they said was very important to the company, and all of a sudden it's not important anymore, what else are they not being truthful about? What else do they really not believe in? Do they not believe in their business plan? Do they not believe in the earnings over the next year? So I think it's really important to be thoughtful about how companies refine programs, change programs to ensure they keep the trust of those large institutional investors.
And finally, Rob, anything else that's on your radar for this proxy season, and what else might REITs need to be watchful for?
So I think there's going to be some surprises this year in proxy season. As I mentioned earlier, I think the vast majority of companies are going to have smooth sailing this proxy season. But I do think companies that are outliers, if you're an outlier on shareholder engagement, if you're an outlier on executive compensation, if you're an outlier in terms of shareholder rights, those companies that are outliers, they're going to draw the attention of the investors, and they're the ones that are most likely to have adverse votes at their meetings. So again, be prepared, talk to your investors, have rich, effective disclosure, but also maybe be prepared for the unexpected this year because there might be a couple surprises.
Excellent, Rob. Thanks for all that very relevant advice, and thanks for joining the podcast.
Thank you, Sarah. It was great talking with you.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.